Okay, so the first question, identify 2 rules designed to limit tax benefits a taxpayer may obtain from a tax shelter investment. All right, so what are 2 rules designed to limit?
The first one is passive loss.
Okay.
It requires taxpayers to separate income and losses into 3 different categories: active, portfolio, and passive.
All right.
That's all.
That's all. All right.
Oh, did you want me to go further?
No, that's right. All right. So the tax benefits associated, usually you're going to look at risk and the passive activity losses. All right. So when we're looking at tax shelters and we're going to talk at risk.
Sorry.
That's right.
No, I have it written down.
She has it written down. At risk limits and then the passive activity losses. All right. We're going to talk real quickly about tax shelters and then we're going to move on. But under these losses, just a couple other notes. A taxpayer deductible loss from activity for any tax year is limited to what they have at risk. And I will go through, actually another question talks about what the at risk is. So Lauren, that was your question. Question number 2 says, list some events that increase and decrease an investor's at risk amount. And do you know what the at risk amount, first of all, what at risk is? Can you tell everybody what that is, kind of?
Not really. I mean, versus the other one.
Okay. Oh, Darshell wants to tell everybody. Okay.
It limits the deductions to the at-risk amount taxpayers lose if their investments become worthless.
Okay. And the at-risk amount is only what you put in. Okay? And then it can go up or down based on the money you make. So like if you make more money and it goes into the investment, it can go up. So for example, I have AT&T stock. All right? But the stock I have has all been given to me by AT&T through bonuses, stock options, and that type of thing. So my at risk in that stock is 0. Even though technically, if AT&T stock went to 0 tomorrow, I would cry because I would be losing what I call my O fund. All right? In the event that we need money, I would cash that out. So to me, I lose money, but my at-risk amount in that money is 0 because I did not put anything into it. All right, yes?
I know how an individual can determine their at risk. They know what they
Right.
put in. From a taxpayer's standpoint, how do we determine at risk?
For stock or for what we're talking about here? Well, here we're talking about companies and the amount of money you put into as an investor when you put in, like what she's going to talk about. If you invest, in the 3 examples I'm going to show you in a second on the slides, we're talking about somebody investing in something. So if you put $20,000 into investment, that's your at risk.
So that's on the books.
It's what you put into the investment.
So like yours.
Mine is 0 because my stock, then that I'm going to tell you that. Now, investing companies like Edward Jones and them have to give you that amount. Where it becomes hard for CPAs and those doing taxes is for people that have had stock a really long time. Then it becomes hard. And if you don't know your basis, you have to claim 0. And that's bad.
Newer stuff they actually do replicate before the stuff that was
Right. Yep. All right. So list some of the things that could increase or decrease.
Increase would be how much they put in.
Okay.
So investing more. Increase of its debt, so what they borrow,
Yes.
put into it.
Okay.
Decrease would be if they have reduction of debt for
Okay.
the activity, and then shares of deductible loss or withdrawals.
Okay. So she named them all. Those are pretty much the top 4. All right. So what you put in, or if there was any increases into it. What was your second thing?
Increase of the debt.
Increase of debt. So if you take on debt, it increases the value. And then she said as you pay off the debt, and then also any withdrawals that you make from it could decrease it also. All right, the third one, or which is number 4 on the discussion questions, explain the meaning of the terms active income, portfolio income, and passive activity income.
Okay, I'm ready.
All right.
Active income, it includes wages, salaries, commissions, bonuses, profits from a trade or business in which the taxpayer is a material participant. Also includes the gain on the sale or the disposition of assets used in an active trade or business. and income from an intangible property if the taxpayer personal efforts significantly contributed to the creation of the property.
Right, very good. Portfolio.
Short than that.
Portfolio. Portfolio includes interest, dividends, annuities, and royalties not derived in the ordinary course of a trade or business. It also includes the gain or loss from the disposition of property that produces portfolio income or is held for investment purposes.
Okay, so do you see the big difference between active income and portfolio? Active income is kind of our day-to-day job, business kind of lifestyle, whereas portfolio is the money that we hope to kind of retire on, right? Our investments, our dividends, our interest, and what we call portfolio if we have a lot of money, right? Our portfolio of investments. All right, and what is our passive activity?
Passive activities includes any trade or business or income-producing activity in which the taxpayer does not materially participate. Subject to certain exceptions, all rental activities, whether the taxpayer materially participates or not.
All right, that is correct. So that is kind of, we're going to talk about rental, and for the most part, rental income is passive, like he said. And then when we don't materially participate, it usually is considered, it is going to be considered passive. All right.
So is that like rental income if you like buy and sell houses and all that?
Well, that's flipping, all right, and that's always going to be considered a capital gain. So if you're not, so that's different. But rental income in the sense that you actually have rental property,
And
that's
considered passive.
that's
income.
considered
Income
passive,
you're not
right.
working and not materially doing anything.
right, unless you're a real estate agent, then you're materially participating. Yeah.
Quick question, how do you, like determine rentals? So like, you still own it,
Right?
but what if you're still paying a mortgage on it, but you're
Well, you can have a mortgage. I mean, most people I know that have rental income
Right.
have mortgages.
Yeah.
So
Right.
it's just what you,
It's the fact that you have
Describe it as.
somebody there who's paying you rent.
right,
So you're getting income for something that you own, whether you have a mortgage on it or you don't have a mortgage on it.
but you can technically have more than one mortgage. So do they,
You could have more than one
but
mortgage.
is it automatically assumed that one of them is a rental property?
Well, yeah, no, because you could have two properties, and you could have a mortgage on two properties and
Right.
claim them both. What you're doing is you put that under Schedule E, which is rental property, and you put the address, and you put that you have income coming in, and you put everything under rental expense there.
So it's only known when you
Right.
state it?
Right,
Okay.
yep. All right, so oops, we gotta move this guy.
Quick question.
Yep, because I need my book too.
Can you, is there somewhere where you have to, you can claim your personal property taxes on your?
Yep, absolutely, it goes under taxes. Yep, so taxes for a rental property will go under, on a Schedule E, you get to claim your taxes, and you'll put them together with your real estate taxes. But yes, you get to, any taxes on your, on that rental. Okay, so, I gotta find yours, because yours isn't on the board here, because the last two questions got cut off. So number 10, discuss what constitutes a passive activity. So we kind of talked about one for you, but what constitutes a passive activity?
I don't know if it's correct. Equipment leasing,
What was that one?
equipment leasing,
Equipment leasing?
rental
Okay.
activities,
Rental activities, yep.
limited partnership,
Okay.
sole proprietorship,
Yep. So any trade or business in which we don't materially participate, right? So we can kind of sum up, he gave us several good examples, all right, of one. So the big key there and what he said in all of his examples is, as long as it produces income and we don't materially participate, it is a passive activity, all right? There are some exceptions. All rental activities, whether we participate or not, are usually going to be passive, whether we participate or not.
Now, if you're like if you own an apartment building and you're renting it out and you're the supervisor,
But supervisor's not the owner. So you gotta make, so if you own the apartment building,
yeah.
are you the supervisor or are you the owner?
Well, some people, they own the building, but they live in it.
Okay,
They're the
but
ones
that's
maintain
different.
it and everything.
Okay, that's different. So what role are you taking now? The person who's doing the taxes on the building? Because then the building, you can own the building, but if it's a rental property, with most exceptions, you're going to, it's passive. With the very few, I said that wrong, but it's going to be passive activity. The reason being is there can be huge losses with rental activities. Okay? So that's why it's limited.
Well, I mean, I get that, but I was just like, if that's your main job, is literally just maintaining this.
Okay.
this
But then
property.
usually, if that's the case, a lot of times you're going to pay yourself a salary. Okay? So you're next. Your question was, dun, 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 what is the significance of the term material participation, and why is the extent of how much we participate important in determining a loss? What is the significance? Can you first tell me what the significance of material participation is?
The significance?
Yeah. Why is material participation significant?
That's the difference between active and passive.
Okay, because it's the difference between whether or not something's going to be passive or active. All right.
And that influences, so like, because passive loss cannot be used against active income.
Right. You cannot use the two against each other. And material participation is determined by the level of participation of the taxpayer. The underlying theory is, and this is what you were trying to get at, I think, when you're doing it, a high enough level of participation indicates that the taxpayer has a high interest in the activity other than an investment. A taxpayer who materially participates in the activity has both an economic interest and an interest in the ongoing source of its livelihood. All right? The thing with rental income is sometimes it falls outside of all that, and there's other rules beyond that. That's what we're getting at. All right, so now when we get to these slides, we're going to go kind of through them at a different pace because we answered these 5 questions. I think I'm hitting the wrong button. There we go. These 5 questions answer things in a different order on the slides. Okay? So when we get to different things, I'll be like, well, we've already talked about that, and we'll just kind of cruise along. If I can get it to come up on the... Where'd it go? I wonder if I don't have this guy right. Now let's try. Oh, well that would help. Hang on. It's not plugged in. See, it should show. There we go. There it goes. Huh?
This time does not come out of my questions.
I know. There's my beautiful babies. They actually were babies.
So young.
They are young. That little guy right there was like, I don't know, 4. Let's try this again. Okay, so it should, I think, be duplicate. Let's see. All right. There we go. Okay, so the big picture that we're going to answer these, and so these will be our examples, is they want to enhance their financial security. So they're looking at 3 different options. Okay, you guys tell me if you think their options look a little funny, because together their income totals $100,000, but their house has a mortgage of $350,000. I don't know, it seems like a high mortgage for $100,000, but that might just be me. The fair market value is $500,000, so the house has appreciated, so that's good. Here's their 3 options that they're looking at. Okay, they're looking at borrowing $100,000 at a 6% interest rate and using the proceeds to do one of the following 3 things. They want us to help them decide. They can do a high growth, low yield marketable security that is expected to yield 8%. All right. They can invest in a limited partnership that owns and operates an orange grove in Florida. It's losing money right now at $25,000 that they expect to continue to lose money for the next 5 years. But after that, they expect an 8% return for the next 8 years. Or they can invest in a local limited partnership that owns and rents apartments to college kids. They lose about $25,000 for the next 5 years, after which they expect profits. Again, expected annual returns of 8% over the next 5 years. They want to know which one is going to give them the best returns over the next 10 years. They know there's some tax restrictions involved, so they want to know the best options. Now, something to keep in mind, tax accountants are usually not investment brokers. So they're wanting to know the tax restrictions. All right. So one thing to keep in mind, depending on the track that you follow with your career, don't confuse tax advantages with being able to really know what their best investment thing is. For example, if we just go back and look at this slide, I don't know which investment they should take. All I can tell them is how it might affect them from a tax perspective. I don't even like doing my own investments. Okay, so just make sure. But there are people that are tax and investment people. You know, so it just depends on the way. If you want to do both, that'd be great. All right, so this was the first slide, which we answered, right? We already talked about active portfolio and passive activities. We go on to define them a little bit more, and we talk about the at-risk rules, which Lauren and Jarchelle actually already talked. And the reason passive losses are subject to at-risk is designed so we don't deduct losses in excess of what our economic investment was. Hence my AT&T example. Why should I be able to deduct losses on something I didn't have any economic investment in? I feel like I do because I've had them for a really long. I haven't worked for AT&T for over 20 years. All right, but I've had that stock for a really long time, and I feel kind of like I have an economic investment because I've reinvested my dividends since I've owned the stock. So I feel like I have an economic investment, but the only thing I've put into AT&T is my dividends. So technically, I do have a basis. When I say I don't have a basis, I do. My basis is my reinvested dividends, and that's it. And that's really hard to calculate. But if I ever had to, I would. If I ever sell that stock, I'll figure that out. So I'm not claiming zero. So at risk, we already had that defined. It's what we have put in or any amounts borrowed. We have 4 slides on it, so obviously it's a big thing. It does not enforce any recourse debt, which Lauren talked about. All right. It can deduct losses only to the extent that our at-risk amount is there. Any losses disallowed can be carried forward. So what that means, if I have a loss, but my at-risk amount is $20,000 and my loss was $30,000, then I can take that $10,000 and I can carry it forward until I can deduct it. So you don't lose it. You just have to carry it forward until the company makes more money. And then when the company gives me that $10,000 I just made, now I can deduct that $10,000 loss. Previous allowed losses must be recaptured, meaning if I deducted something, then I would possibly have to recapture them. It's kind of like we talked about on depreciation when you go to sell something. And at-risk limitations must be recomputed for each activity for each taxpayer separately. So husband and wife are each taxpayer, each activity. So if you have multi-activities and each taxpayer is in it, then that's fine. Okay, thanks. All right, at-risk is applied first to each activity to determine a maximum allowed for each year. Then passive loss limitations are applied to all losses from all passive. So first you figure out what's at risk, then you apply your passive loss limitations. So this slide has a summary of what those calculation of at risk, what can increases and what can decreases. And that is actually, I think I marked it on page, if you just want to have a quick look and not have to, it is on page 11.5. It's concept summary 11.1. So they have 3 options, all right? In addition, they added a 4th. If they invest $40,000 in an oil partnership that incurs a first-year loss of $20,000, or $60,000, sorry, assume the resurrect's interest in the partnership is subject to at-risk but no passive losses, what can they deduct in the first year? 40. Yeah. All right. And then they're going to carry forward the 20, right? Because all they're at risk of losing is $40,000. They can carry forward the 20 in the event that they get more money put back to them. Does that make sense, everybody? Brian, you kind of looked at me with a rolled eye, but you got it? Okay. So, now I'm going to carry it forward. They're going to make more money. So follow along. We're going to assume different facts. In 2019, we have a taxable income of $15,000. And we decided to invest $10,000 more into the partnership. Their new at-risk amount is $25,000. We have our taxable income plus our $10,000, so we now have $25,000. All right. So our beginning balance plus the $15,000 plus the 10, what did we carry forward? A $20,000 loss. So now we have a new at-risk amount of $5,000. So even though we put 25 in, we carried forward a $20,000 loss. So our at-risk amount isn't 25,000; it's actually 5.
Not bad.
Not bad. Make sense? Awesome. All right, passive activity. Let's look at those passive losses. So we're on number 3 of those little. We already talked about these slides. Jimmy did a good job. He talked about portfolio income. He did a good job. And there's our passive activity. So let's talk about these limits. All right, limits are defined or disallowed or suspended and can be also carried forward. So this carried forward of losses is usually where you guys are like, you know, how do we do that? You literally carry forward what you didn't use. Okay? So let's look at the facts of this for an example. In addition to their salaries, we received $12,000 of dividends. All right? Dividends are going to be passive. All right? So they decide to invest $100,000 in the orange grove. The orange grove is the one that is losing $25,000 a year. So based on this, the current loss is not limited by the at-risk rules because it's passive. However, the loss is passive. We cannot deduct it against their other income, so the loss is suspended. All right. Now, it's suspended. It can offset against other passive income. It will be allowed when they dispose of other passive activities. So they're just going to have to carry that $25,000. So before we even get to the end of the slides, what do you see is going to be a problem with the 2 investments that lose $25,000 a year for the next 5 years?
They won't be able to do it.
Yeah, based on their current income of $100,000 a year with no other passive activity coming in, they can't deduct it. So it's just going to sit there. Now, it's going to carry forward, right?
Right.
But right now, in the short term, it's not beneficial.
Wouldn't they materially participate in the orange grove though, and making it active instead of passive?
I don't think in the orange grove they were materially. I don't think they were materially participating in anything. Yeah, but I think they aren't in Florida. But I don't want to quote that till we get to the end. All right. Suspended losses are deductible in the year in which the transaction is actually disposed of. So in the event that they were to dispose of something, if you're carrying suspended losses, then you would be able to deduct them. So, for an example, Roy has an office building. It's a passive activity with an adjusted basis of $400, and he got rid of it for $560. So he sold it as a profit. In addition, he had suspended losses he hadn't been able to use, associated with the building. So the first thing is you figure out the gain, then he gets the losses. So actually, in the end, he only had a $40,000 gain. So in the end, it worked out, but throughout this whole process, he wasn't able to take those losses.
He had sold the building at a loss.
Then,
He still would be worth it.
no, because you're going to be limited on your extent of your passive losses of $25,000. All right, credits. I added a little note here, and I will put it out on Blackboard. These slides are slightly edited. They're not big edits, but all it said on these slides was credits. And if you read your book, which most of you don't, but if you read your book, you'll see that credits deal with things like low-income housing and rehabilitation credits, which we'll talk about in Chapter 13. But all it says in the PowerPoint is credits. And that's not going to be very it doesn't explain very much. So I just added that little word, such as low-income housing credits, from passive activities are subject to loss limits. So if you're getting credits for things like low-income housing credit or rehabilitation credits on your taxes, they're going to be subject to loss limitations. You can't get a whole bunch of those credits. You're utilize the passive credits to the extent of regular tax attributable to the passive income. So you can use them, all right, and you can use them just like as much as you could. The credits are disallowed, are suspended and carried forward. So any credits that you can't use towards the activity for this purpose, because the credits are going to be on the page 2 of the 1040. All right? Even though it is a half sheet, there's still a page 2. Okay? Which is really dumb.
So,
Why didn't they just make it one page? They didn't. It's just 2 half pages. Okay.
this is the credit for offering low-income housing.
For offering low-income housing and for offering rehab credits to certain housing. So like if I rehab my house, they really don't care. Okay? But if I go rehab a house in certain areas, I will get credit for doing that. They'll give me certain credits for doing that. Basically trying to improve different areas.
But it's not like a rental property.
No, not well. It depends if you own a rental property in the right area. Okay. What was the beautification? Yeah,
Yeah.
trying. Yeah.
What if you put on like section 8? Still doesn't.
I don't know if Section 8 is necessarily
Like,
what.
you have a rental property, but
You're getting way too technical on that one right there. All right. Now, if a formerly passive activity becomes active, all right, which can happen, if a formerly passive activity becomes active, then your suspended losses are allowed to the extent of income. So whatever income you now have from your active business, your suspended losses are allowed to decrease that. And then any remaining suspended losses continue to be treated as a loss from the passive activity against other passive income. So you only can take you only can take the losses to the income that you have for that new business, and then the rest stay as suspended losses. All right, passive loss rules apply to individuals, estates, trusts, personal service corporations, closely held corporations, S corps, partnerships. All those passive losses apply to. All right, so passive losses are losses from trade or business activity in which taxpayer does not materially participate. Notice it's in italics, so we're going to talk about that. And certain real estate. So what constitutes activity, what constitutes material participation, and when is an activity a rental activity? All right, so taxpayers with complex business operations must determine if segments of their business are separate or if the entire business is going to be treated as one. So that has to be decided up front. Regulations for grouping the business, if they're appropriate, but once you group your activities, you cannot ungroup them unless the groups are clearly inappropriate or there's a material change. So basically, once you decide it's going to be one activity or separate, that's pretty much the way it stays. Now, special grouping rules for a rental. And this is kind of, Katie started talking about this. Designed to prevent grouping of rental activities that are generally passive with other businesses that would generally be active. Right? They're trying to make sure you don't take a rental company or rental activity and group it with a trade when basically there's no reason to group those two things together. All right? Taxpayers generally may not treat an activity involving the rental of real property and an activity involving the rental of personal property as a single activity.
What if they own like a coffee shop downstairs?
2 different activities. All right? One's a business, one's real property. You've got to keep those two separate. So, Katie was talking about material participation. There are 7 tests to material participation. This is on page 1114. Now, it sounds harder than it is, okay? You don't have to memorize all 14 tests because, of course, your book is open book. I also like to note that on page 11, I haven't gotten there yet. Never mind, I don't have to note it because we're not there yet. So what page did I say? 1114. Mm-hmm. So on 1114, it's concept summary 2. There are 7. If you meet one of them, all right, then you're passive. I mean, you're materially participating. So that's not subject to passive. So the first one, do work. you materially participate for more than 500 hours in a year. All right? For those of you that aren't aware, there are 2,040 work hours in a year. If you are a normal person who works a normal 9-to-5 job, I'm not sure what that is anymore, but if you are a normal person who works 9 to 5, there's 2,040 hours in a year. Or is it 2,080? I was in public accounting, and one of them was 2040, and the other one was 2380. So 500 is a quarter of the time, basically, is what they're saying. Okay? 2, taxpayers' participation in the activity is substantially all of the participation in the activity of all individuals. So it might not be 500 hours, but you are doing everything that it takes. So when you are renting property, you have a rental house, you might not be working on it for 500 hours out of the year, but you're the only one doing it. Therefore, you're materially participating because nobody else does anything. All right? Test 3, the taxpayer participates in activity for more than 100 hours and not less than anybody else in the activity. So you might have a rental property or business with somebody else, and you might participate for 150 hours, but your partner also only does it for 100 or 150 hours. So you're materially participating even though you're not over 500 hours. It's just a small business, huh?
Can we go back to test 2 real quick?
That one?
Yes. Say it one more time.
Taxpayers' participation in the activity is substantially all of the participation in the activity of all the individuals for the year.
They're the only one.
You're the only one.
So you're the only one who does anything for the whole business.
Right. That's what I said. So basically, you're not working on your rental house for more than 100 hours, not 500, but you're the only one working on it. So you're materially participating because nobody else is doing anything.
What if it's just one aspect of the activity?
Nope, we just said you're either grouped or you're individual. Grouped or individual. There's not one aspect. It's either this is the material. So taxpayer is substantially participating in the activity. The activity is the house. The activity is the thing. So it's not one part of it. If you're doing one part of it and there's somebody else doing another part and there's somebody else doing another part, then you're not doing all of it. So then you'd have to go to this one and say there's 100 hours and you're doing 100, but it's not during the year and not less than anybody else. So you might only be doing 100, but the other people are all doing right at 100 also. Okay? 4, participation in the activity is significant, and the taxpayer's aggregate participation in all significant participation activities during the year exceeds 500. Significant participation is more than 100. All right, so I know. So your activity is significant, and the taxpayer's aggregate participation in all significant participation activities during the year exceeds 500. Significant participation for everybody is more than 100 hours. So this one, to me, is the most confusing, part 1.
Doesn't it pretty much say as long as you meet all the others?
That, to me, that's what it says. That's exactly what I get out of this one, too.
It's
more than 100.
You're kind of, that's like...
And it's a significant portion. Now, these next couple are the weird ones. Taxpayer materially participates in activity for 5 of the last 10 years.
So they had to take a year off because he got sick.
They took a year off, they took 2 years off, they took 5 years off. But in 5 of the last 10 years, they significantly participated. You are still materially participating. The activity is a personal service activity in which the taxpayer materially participated for 3 of the last years. And then the last one, based on the facts and circumstances, the taxpayer participated in the activity on a regular, continuous, and substantial basis that is not picked up in 1 through 6.
So you did, more than likely.
Well, no, I mean,
So that's like what I was saying. So like you're the only one. So like you have your coffee shop, and you're the only one who does receiving. So it might not equal the same as the person who's always working the register.
regular, but
You're always doing
Right.
the receiving. You're the only one.
then
who
you
does
materially
it.
participated.
Yeah. Okay.
Okay, but remember, you're also going to be the one that is filing the taxes. So if you own the copy shop and you are the one who's in the back, who's there on a regular, continuous and substantial basis, then you are materially participating. All right? So yeah, I mean, somebody that owns a business, a small business, is very rarely not going to be materially participating.
They're gonna be hands-on.
Right. And if it's not open very much or it's very small, they're going to be materially participating because of under the 100 hours or under the last 5 years out of 10, because that's where you get businesses that are starting to grow, where you don't need to be as hands-on anymore, but you're still materially participating because you're probably still making a lot of decisions, even though you're still not there. All right, go ahead. Participation is defined as any work done by an individual in an activity that he or she owns. The work does not include any type of customarily work done by owners, and if one of its principal purposes is to avoid disallowance of the credit. Meaning, you can't sit there and say to yourself, what do I have to do to make sure I get 500 hours? All right? Which is, there's an ethics case in here. If you get time to read it, it just gives you an idea of what people could do, all right, to do it. Work done in an individual capacity as an investor is not counted. Investors do not usually materially participate. And participation by an owner's spouse counts as an owner. That also is involved in the ethics case in the chapter. An owner and a spouse are one. Yes?
Okay, back to this principal purpose which we're talking about.
Right.
Okay, so if you own this coffee shop, we'll keep using her coffee shop. It has to be 500 hours. So you sit there, you divide out 500 hours and say, if I work this many Saturdays, then it's material to participation. Is that what this?
No, because they're actually working. If they're in there actually working, it says does not include work if of a type that not customarily done by owners. So what are they in there doing?
Cleaning up.
If they're cleaning the bathrooms, then no, that's not going to count. If they're in there doing the books or cleaning, working behind the counter or greeting the customers, those would all be things done by the owners. If they're in there in the back checking the stock and doing that stuff, that would be done by owners. If they're at a bar and they're behind the bar, that's stuff that would be done by owners.
They clean the bathrooms a couple places that really need that.
Well, that's true. If they're shorthanded and they're doing whatever needs to be done, then that could be also justified. So it's, and then you guys usually follow that question with how are they going to know? All right? Someone's going to ask that? All right. So it is going to be hard to know. But if you go into some of these places, and the ethics case is a perfect example because they're starting to count, well, we think about it when we go to dinner. We think about it when we're talking about this and we're talking about, that stuff doesn't count. All right? If you're in it doing work, most of the time you're going to be fine. But you can't say that you were in there on a Saturday doing work and you're never in there on a Saturday doing work. Okay?
But
If I
it's
show up
any
to your
type of
store
work.
and be like, hey, have you ever seen me walk?
Yeah, right. So the thing is, you're not going to try. The rules have to be written for the purpose of hoping that people follow them. Okay? All right. So let's take a look at a problem I got for you guys.